Understanding the Relative Volatility Index starts with recognizing its purpose in trading analysis. The Relative Volatility Index, or RVI, is a momentum oscillator designed to measure the direction of volatility rather than price movement. It was developed by Donald Dorsey. While similar to the Relative Strength Index, or RSI, the RVI focuses on volatility rather than price. RSI measures price momentum based on closing prices, while RVI measures volatility momentum using standard deviation calculations. RVI helps traders visualize whether volatility is increasing in the same direction as the price trend or against it. In periods of high volatility, RVI can help identify whether this volatility supports the current trend or signals a potential reversal. The primary value of RVI lies in its ability to confirm trend strength and identify potential reversals by analyzing volatility patterns. It helps traders determine if volatility is supporting or contradicting the current price movement. To summarize, the Relative Volatility Index is a momentum oscillator that measures the direction of volatility. What makes it particularly valuable is that it doesn't just measure how volatile a market is, but whether that volatility is moving in the same direction as price or against it. The Relative Volatility Index compares the standard deviation of up closes versus down closes over a specified time period, typically 10 days. RVI produces readings between 0 and 100, similar to other oscillators. Values above 50 indicate that volatility favors the upside, suggesting bullish momentum, while values below 50 indicate volatility favors the downside, suggesting bearish momentum. The closer RVI readings are to the extremes, 0 or 100, the stronger the signal. Let's look at how RVI values correspond to different market conditions. In an uptrend, RVI rises above 50, indicating bullish momentum. During a downtrend, RVI falls below 50, showing bearish momentum. In sideways markets, RVI tends to fluctuate near the 50 level. And in a strong uptrend, RVI moves decisively higher, indicating powerful bullish momentum. RVI and RSI are both popular technical indicators with important differences. Both are bounded oscillators, ranging from 0 to 100, but they measure fundamentally different aspects of market behavior. RSI tracks price momentum by comparing the magnitude of recent gains to recent losses. RVI, however, focuses on volatility direction rather than price direction. RSI's calculation is based on the relative strength of price gains versus losses, while RVI uses standard deviation to measure volatility changes over time. RSI typically performs better in trending markets with consistent price movement. RVI shines in volatile markets where price action alone might be misleading. RSI is reliable for identifying potential price reversals based on momentum. RVI excels at detecting shifts in market volatility that often precede significant price movements. Despite their differences, RSI and RVI share several important characteristics. In volatile markets, RVI often provides more responsive signals than RSI. Let's compare their behavior. The RSI tends to show more gradual changes, focusing on price momentum regardless of volatility. The RVI responds more dramatically to volatility shifts, making it valuable in choppy markets. These indicators work best when used together, providing complementary insights for more complete market analysis. The RVI indicator typically includes a signal line, which is a moving average of the RVI itself, usually a 4-period moving average. Traders watch for crossovers between the RVI and its signal line on charts like this. When the RVI, shown in white, crosses above its signal line in gold, it generates a bullish signal. Conversely, when the RVI crosses below its signal line, it generates a bearish signal. These crossovers help traders identify potential entry and exit points for their trades. For example, a trader might see the RVI cross above the signal line and enter a long position at this point. RVI crossovers often signal short-term countertrend moves, making them valuable for identifying potential reversals in momentum. The key takeaway is that RVI crossovers provide timely trading signals, but they should be confirmed with other technical indicators for better accuracy. The Relative Volatility Index, or RVI, can identify overbought and oversold market conditions. As an oscillator, RVI ranges from 0 to 100 with key threshold levels at 30 and 70. Readings below 30 are considered oversold, suggesting a potential reversal to the upside. Readings above 70 are typically considered overbought, indicating a potential reversal to the downside. However, it's important to note that during strong trends, the RVI can remain in overbought or oversold territory for extended periods. These signals should be used with caution and ideally confirmed with other technical indicators. A strong uptrend can keep RVI overbought for long periods. Premature selling based solely on this signal could mean missing significant parts of the trend. For best results, combine RVI overbought and oversold signals with trend analysis, support and resistance levels, and other technical indicators. Divergence analysis is a powerful technique for identifying potential trend reversals using the Relative Volatility Index. Divergence occurs when price movement and the RVI indicator move in opposite directions. This disconnect signals a potential weakening in the current trend momentum. Bullish divergence forms when price makes lower lows while the RVI makes higher lows. This suggests weakening downward momentum. Notice how price continues to make lower lows, but the RVI is starting to make higher lows. This divergence can signal a bullish reversal as selling pressure diminishes. Bearish divergence forms when price makes higher highs while the RVI makes lower highs. This suggests weakening upward momentum. In this case, price continues to push higher, making new highs, while the RVI fails to confirm the strength, making lower highs. This divergence can signal a bearish reversal as buying momentum weakens. While divergences are powerful signals, they should be confirmed with other indicators and price action. False divergences are common, especially in strong trends. Always wait for additional confirmation before taking action based solely on divergence signals. Let's explore practical trading strategies using the Relative Volatility Index. There are 5 effective strategies for trading with the Relative Volatility Index. We'll explore each one in detail. The first strategy uses RVI and signal line crossovers to identify entry and exit points. When the RVI line crosses above the signal line, it generates a buy signal. Conversely, when the RVI crosses below the signal line, it suggests a selling opportunity. The second strategy focuses on divergence between price action and the RVI indicator. Bearish divergence occurs when price makes higher highs while the RVI makes lower highs. This signals a potential downward reversal and provides an opportunity to take profit or initiate short positions. The third strategy combines RVI with trend indicators like moving averages. This approach enhances reliability by using the trend indicator to identify the overall market direction while using RVI to confirm entries and exits. For example, in an uptrend confirmed by a rising moving average, an RVI crossover provides an ideal entry point. The fourth strategy uses RVI to validate breakouts from chart patterns. When price breaks out from a pattern like a triangle, checking the RVI strength helps confirm whether the breakout is likely to continue or fail. Strong RVI readings above 50 during an upside breakout suggest higher probability of success. The fifth strategy uses RVI as a filter for signals generated by other technical indicators. By only taking trades that are confirmed by strong RVI readings, you can improve your trading accuracy. In this example, the MACD buy signal is confirmed by a strong RVI reading, while other signals are filtered out due to weak RVI confirmation. For the most robust results, RVI should be incorporated into a comprehensive trading system rather than used in isolation. This approach integrates RVI with trend indicators, support and resistance levels, and proper risk management. By combining these elements, traders can develop a more reliable strategy that addresses both entry timing and risk control. The Relative Volatility Index, like all technical indicators, has limitations traders should be aware of. First, RVI can generate false signals in choppy sideways markets with no clear trend direction. Second, the RVI tends to lag during rapid price changes, potentially causing delayed entry or exit signals. Third, During strong trends, RVI can remain in extreme zones for extended periods, making it difficult to identify reversal points. Understanding these limitations helps us develop best practices for using the RVI effectively. First, use multiple timeframes for confirmation. Check if the RVI shows the same signal across different timeframes before taking action. Second, combine RVI with other indicators, especially trend-following ones like moving averages. The most reliable signals occur when multiple indicators align. Third, adjust the RVI look-back period based on the asset's volatility characteristics. More volatile assets may benefit from longer periods to filter noise. Finally, always use proper risk management regardless of how strong the RVI signal appears. Set stop losses and take profit levels with a favorable risk-to-reward ratio. To summarize, understanding the limitations of RVI and following these best practices will help you use this indicator more effectively in your trading strategy.